Hey, what's up, everyone? Welcome back to By the Bay. I'm your host, Dan Ancheta. Appreciate you being here for an episode with just me today. And something that I've been really thinking about lately is conversations I've been having with referral partners and with clients about what's going on in today's real estate market. And the question keeps coming up is it a buyer's market? Is it a seller's market? Is it something else? And I wanted to just chat about that for a little while. So the kind of definition of a seller's market is when a seller can list their house, they're going to get multiple offers, they're going to be able to negotiate with the best offer or maybe the best few offers, and they kind of get to pick who is going to be the buyer to buy their home. They have the pricing power. They have the power to dictate the conditions of the sale, meaning how long the escrow needs to be, do they get a rent back, what's included in the sale, et cetera, et cetera. And a buyer's market is the inverse of that, meaning that there are fewer buyers, more housing availability, and the buyers are able to negotiate things like seller credits, price reductions, incentives, potentially if it's a new construction build, or other factors like how quickly the transaction needs to close. Is it contingent on the sale of their current residence or not, and a few other things. So the question is, today where we stand, is it a buyer's market or a seller's market? And I think the answer is both. I think the answer is, depending on where you are in the state or in the country, it might be a buyer's market or it might be a seller's market, but it's definitely not in equilibrium, which I think is the optimum state. Meaning, in a perfect market, there are a few buyers for each home that's for sale, so that there is competition to find the true value of the home. And the value of the home is where a buyer and a seller are willing to do a deal together. It's where the price that the seller is willing to sell for and the same price that the buyer is willing to buy for. We see a lot of slack right now in the housing market where there are sellers who are still listing their house at a much higher price than what the current market is yielding, and they're doing price reductions. And that keeps coming down until they get to the point where a buyer goes, hey, I'm willing to buy the house for that price. I wasn't willing to buy at $1 million, but for $950, that's a good deal for me. So in an ideal market, you're going to have a few buyers, not 50, not 100, but a few, 3, 4, 5, that are interested in the house, that are going to make an offer, and gives the seller the option to negotiate with either the best one or the best few to find the optimum price and the optimum conditions where there is a give and take from the buyer and the seller. There's an actual negotiation that happens between the two. What we've been seeing in the market over the last few years, especially during the COVID days, was there wasn't much of negotiation happening. It was mostly buyers giving whatever the seller wanted and doing whatever the seller wanted. They were making offers with no contingencies. They were making offers with no appraisals. They were making offers, in crazy fast times, sometimes in my experience, without even actually seeing the house. They looked at it online. Their agent would go look at it. But sometimes we had a few clients that bought it sight unseen. That's ridiculous. Honestly, that's crazy. Think about that. You test drive a car before you take it off the lot, and there's some guarantees about what that car is going to do, and you can return it to the dealership if it's a bad one. Like, you're buying a piece of real estate, a house that's been lived in, that is maybe 10 or 15 or maybe sometimes 50 years old, that you need to know what's actually there before you decide to own it. What's the cost of that going to be? Anyway, so the market's not been in a healthy place. It's been great for sellers, but not in equilibrium, not in balance, not in a healthy place. So with rates increasing in the past 12 months or so, we've seen activity from the buyer side slow down, which has forced sellers to have to be more competitive, to have to come down and actually negotiate with buyers, which is great. And then the rates kept going up and kept going up and kept going up until the point where there's fewer and fewer and fewer buyers in the market. And we were seeing sellers doing price reductions, big concessions. I mean, in some instances, hundreds of thousands of dollars off the price of some luxury properties to try to entice buyers to come into the market and to buy the real estate. People were so afraid about what rates were going to do and what the overall cost of borrowing was that they just kind of froze. A few weeks ago, we saw rates pop down into the 5%, like high fives, 5.75, 5.875, 5.99, that range, depending on the exact market and kind of mortgage distribution channel you're talking about. And there's all this talk on social media. Rates are coming down. Hurry, hurry, hurry. Let's go. And we saw mortgage applications go up. We saw listings kind of stay flat or actually decrease a little bit. And we had another frenzy, another few weeks where we were seeing clients of ours making offers, seeing 10, 15 offers on houses. And it was like, oh, great, here we go again. And then in this last 7, 8 trading days, we've seen the 10-year treasury go up. I looked at it just a few minutes ago. It's like 3.86. It was down like 3.4 or something, maybe a week and a half ago. So those rates that were in the 5s are back up in the mid to high 6s. I was actually doing some price shopping with some competitors, and they're in the 7s. So all that to say, we've been on this back and forth swing. We've been in a buyer's market. We're in a seller's market. We're back to buyers, back to sellers. Eventually we'll find an equilibrium, and that's really where we want to be. A healthy housing market is one where there is ample housing and ample buyers so that people can trade up from the small house that's not working for them into a larger family house. They can trade down from the family house into the retirement kind of community or the condo with less maintenance. That's a healthy place. We want people to transact. We want them to have houses that meet the needs of their current family and not be stuck in a house because they've got a great rate or because it's too expensive. And it's a healthy thing for the market to be more in balance. If the sellers are winning too much, that's not good for the market in the long term. If the buyers are winning too much, that's also not good in the long term. We need to have that equilibrium so that builders and investors will continue to build and improve, flip, fix, optimize real estate spaces so that there are more housing units to make up for the current demands in the centers where people are wanting to live. Overall, there is a national housing shortage. There are not enough houses in places where people currently are living, and we need to build more houses. The only way to do that is to have a predictable housing market and predictable trends so that builders who might start a process now and not actually start breaking ground and being able to sell houses for 5, 6, 7, 10 years, depending on the municipality that they're working with, they need the reassurance and knowing that there's going to be a healthy, balanced housing market when they actually bring those units to market. Otherwise, they'll just stop. So where are we now? Here in Sonoma County, we have gone back and forth. 6 months ago, it was a buyer's market, 100%. A month ago, sellers had a little bit more of an advantage. Today, where we stand, I'm not quite sure because I think there are more buyers that have come to the market saying, hey, it's the spring buying season, summer's around the corner, turns out I don't want to be a renter anymore, and they're looking for real estate. And all the messaging that happened in the last few weeks about rates being down in the 5s has gotten their hopes up. They're back in the market. They want to start looking again. And now when they actually go to lock their rates, they're going to be in the 6s or 7s potentially if this trend continues. 10-year treasuries pushing the 4% mark. We're breaking all sorts of key financial metrics that dictates where the rates are going. I won't bore you with it, but the mortgage-backed security coupons are trading right around the par rate, which means that's not good overall for mortgage rates. If they continue on the trend, we're going to see rates go up to a different coupon. Not good for the overall rate trend. So where are we today? We are in flux. We have buyers who have their hopes up because of the marketing messaging that we've been doing, and we have sellers that are not sure if they're pricing their houses correctly. They're not sure where they're going to wind up on their next buy side, and it's a market that is moving very fast. So working with a local expert that knows the specifics of what's happening in a neighborhood, a zip code, a school district, a housing tract is super important. And also keeping your finger on the pulse with your lender about what's happening with rates for your specific loan program. Not every program is as volatile as others. There are some that trade more actively, that have a lot more volatility, and others that are a little bit more steady. So having open communication, talking through these things, understanding that the rate that you might be quoted today may not be the rate you actually wind up with, and being mindful of the lenders out there who will quote you a very, very optimistic rate. That's the nice way to say that, a very optimistic rate today because they're not locking you today. And then when you actually go to lock your rate, it's a very different interest rate in the future. If that's happening to you, there should have been communication throughout the process to say, hey, I know I quoted you 6%. That was real 3 weeks ago. This is what's happened with the market, and rates have gone up. And now you're looking at like a 6.5, a 6.75 rate. Here's what that means in your overall affordability. Here's what that means to your overall payment. Do you qualify still for the house that I told you can qualify for 3 or 4 weeks ago? Having more active communication is what you need to be doing as a home buyer right now. Lastly, I'm going to kind of talk about nationally. And I think one of the important factors that we need to be looking at is what happens next in the housing market. What data is coming out that's going to dictate what goes on with mortgage rates and therefore buyer demand and therefore housing price strategy. We have a very, very important next few months with inflation data, housing data, and overall interest rate adjustments that the Fed's going to make. We have fortunately and unfortunately, double-sided, two sides of the same coin, had employment data that has continued to excel, which is great because that means that more people are working and overall full employment is good. Unfortunately, that means that there are still employers out there that are paying higher and higher and higher wages to attract talent because they need to, and therefore increasing the problem with inflation. So we have to slow down the jobs market. I believe that the Fed is going to continue to increase rates until until the job market slows down. We have to see small or even negative jobs data so that the Fed can see that their increasing rate policies have impacted business decisions to hire, to grow, to slow down the economy, to stop inflation in its tracks. If we see housing data, I keep saying housing, if we see employment data continue to gain momentum, we are not going to see the Fed slow down. If we see jobs data start to slow and income trends to kind of pause or even retrace a little bit, that will be a signal to the Fed that they can stop the rate increases and slow down with their overall policies of increasing rates to stop inflation. They're well above their target range right now, and they need real data that real households in this country are having to make tougher choices when it comes to how they're spending their money, and therefore slowing down the pace of how quickly the cost of goods is going up. So if you're looking at some indicators out there, look for housing. Housing trends are going to be super dependent on jobs data and looking at jobs, unemployment, first-time unemployment filings. So look for those headlines, and that's going to tell you where the overall national trend is going. That being said, there are pockets in the country that, despite those trends, are continuing to see housing prices go up, still have 10, 20, 15 offers on the very few listings that we have, because we're also dealing with a shortage of total housing units. There are not enough houses in this country. We have to build more houses. So there are big macro trends that we're looking at that impact real people in our communities. So be looking at that jobs data, and also when you can, we need to have more advocacy for smart development, for sustainable growth in our communities, and building the right types of houses that meet the needs of our communities, not just super high-end houses, things for the middle class Americans to own and live in. They are the driving force of the economy, and those are the big macro factors. So in summary, where are we today? It's both a buyer's and a seller's market, depending on where you are. Working with a local professional is going to be able to sort that out for you with exactly what's happening where you live or where you want to live. And looking at the overall trends, employment data has to slow down, and we need to build more houses. So that's the kind of recap of where we are sitting here in the middle of February, 2023. And hopefully that's useful to you. If you have any questions, if you want me to answer them, I'm happy to do an episode just answering viewer questions and listener questions, I guess, depending on how you're consuming this. And I would love to interact with you in that way. So please email me, dan@seqmtg.com, which is obviously in the show notes, or hit me up on social, on Instagram, Facebook, or LinkedIn, wherever else. And I'd love to do an episode just answering your questions about what's going on with real estate and housing, and anything else that you want to know. So thanks for joining me on this episode. Please make sure to follow us and subscribe on Apple Podcast, on Spotify and YouTube, and follow us on Instagram so that we can connect and do some more interaction. Thanks for checking us out, and I'll see you in the next episode.